Okay, most of Wall Street is convinced that March 2020 was the start of a new long-term bull market. Before you jump into this market, I just want to show a few charts that sort of at minimum poke holes in that argument. And the key to understanding where we are in the market is to understand that authentic bull markets, they arise out of deep-seated pessimism, right? That's the kind of sentiment that precipitates long-term market bottoms. And everything we see today says that we have the polar opposite sentiment condition. Just a quick look at this chart of the S&P 500, right? All we're doing here is we're plotting the S&P against the Ridex bull-bear ratio, right? Money invested in bullish funds versus money invested in bearish funds. On December 1, the ratio jumped to 41.5, right? Investors had almost 42 times as much money invested in bullish funds as bearish funds. The ratio is up 63% since the S&P's high in February, and that ratio was a record at the time. In other words, investors are not showing pessimism at all. They have placed a lopsided wager on the bullish side of the market. All right, but you can easily say, look, that's just 2020, right? Everything's out of whack in 2020. Can we really rely on a sentiment extreme that only goes back 1 year? And the answer is obviously no, which is why I want to show everybody this chart. This chart goes back through 2018. It shows the cost to hedge against a 10% decline in the NASDAQ 100 index. Okay, so obviously this cost is going to rise if investors are fearful about a decline in stocks. The cost is going to fall if investors are complacent. In November, the cost fell to its lowest level since January 2018, all right? Back then, that reading marked the start of a 12% decline in stocks. The coming decline, we think, will be far more dramatic. That's based on various reasons that we talk about in the letter. But the bottom line is that investors are complacent right now, right? And ironically, this complacency toward a decline makes a genuine bear market even more probable. Okay, so we've seen a 1-year extreme in complacency in the S&P. We have a 3-year extreme in the NASDAQ. Let's go back even further and look at a third index, the Dow. This chart just plots the percent bulls in the weekly Investors Intelligence Advisors Service, right? So these are weekly sentiment figures. Percentage of bulls just pushed to nearly 65%. That doesn't sound that lopsided, but it's actually the second most optimistic extreme since 1987. And notice too, that several of the recent sentiment extremes equal or exceed the ones that occurred in that January to March 2000 period, right? Back then, those extremes coincided with a major stock market high, and the extremes we see today exceed those highs. You can read our analysis of these readings in the letter, but the reason that sentiment is extreme today is because a fifth wave up is very late in its development. Okay, so just to recap quickly, we've got a complacent extreme in the S&P. That's at a 1-year high. We've got complacency in the NASDAQ. That's at a 3-year high. We've got bullishness in the Dow at multi-decade highs. And we have major investment houses looking for big gains in 2021 in the stock market. One firm is actually forecasting 17% gains by the end of 2021. Now, nothing is certain in market analysis. We say that time and again, but we think a lot of people are going to be surprised by just how weak the market becomes in 2021.